With all that cash, I guess, on the proverbial sideline here, it doesn't necessarily need to come out of fixed income, but is there some sense here that people are willing to maybe extend duration just a bit?
Well, I think there's two elements of that, what's going on, Romaine. Number one, you have the consistent element of the drumbeat of money market funds attraction. And admittedly, that's probably going to continue for some period of time. Typically, we see investors, typically retail investors, continue to hover in those money market funds for another 12 to 18 months beyond the initial rate cut. The second component, though, is how you continue to find resilient returns after those money market yields continue to decline. And we've already seen a decline of 50 to 60 basis points in money market funds. It hasn't necessarily been the alarm to sound people to move out of money market funds yet, but it is the alarm for people to begin to reconfigure and have portfolios positioned for better total returns. And part of that total return perspective is ability to generate price appreciation in bond portfolios. So one element is people looking for diversification away from equities and other more volatile risk asset classes. The second allocation is people focus on looking at total returns with a lower volatility footprint. And that's exactly where we're seeing more important folks focus on moving out of bills, focusing on the front end of the yield curve, predominantly the 5-year point, and doing so in a methodical way over the course of the next few weeks, the next few months, and more importantly, the next few years as they look at fixed income as that alternative.
Well, what's kind of the entry point for maybe those investors that don't have that exposure, or at least not in a meaningful way? Because the narrative was pretty clear just a few weeks ago. Rates were going down, and they were going down meaningfully. We seem to have stalled. You have some folks saying that the Fed might not be aggressive, and you had Torsten Slok at Apollo just today saying he doesn't think the Fed's going to cut again in November at all.
Yeah, I think what's most important here is that the Fed is intent on securing that soft landing, and they have a real possibility of doing so. I think the data dependency by the market is really something that became focal point for the past few weeks. We've recalibrated to higher yields of 40 to 50 basis points since that point in time. And more importantly, when we think about this, the evolution of securing that soft landing means that the possibility of continued easing remains intact, but maybe the motivation and, more importantly, the method of how they're going to ease might be more elongated than the market had expected. And that's simply the recalibration, a natural recalibration that we should come to expect over that point in time. For investors, practically speaking, what we want to do is help avoid the fixation on the market-to-market, moment-to-moment move of data and really focus on the bigger term opportunity here, which is yields are high. The potential for total returns for investment portfolios is also high at this point in time. So the point being is that the exact precision of when you enter into allocating to fixed income is a little bit less meaningful in terms of investor returns than people had suspected back, when rates were back at 0%. The time is effectively now to begin to allocate to fixed income, which there is a structural underweight, which remains, and then move beyond that. And so while people are fixated on the Fed, the reality is that this might be a more elongated process.
People are fixated on the Fed. They're also worried about the election. How are you thinking about how the election changes things up? Matt Hornback over at Morgan Stanley says Treasuries are better positioned this time around than in 2016 when we had a GOP sweep of the White House and Congress.
Right. Well, first and foremost, there is obviously a lot of volatility that's going to be perceived to come out of the election. There's other risks in the marketplace, too, not to differentiate, but geopolitical risks. We also have longer-term risk with regard to liquidity. We had a speech from Lori Logan earlier this morning focusing on those structural elements. So there's a lot of things to discern as professional portfolio managers as well as investors around within the marketplace. The question you ultimately have to answer is what venues offer the best risk premium given these uncertainties? And that's where you can find a little bit of that shelter in the fixed income space right now, despite the backup in yields, despite the outlook of where the economy is going. Generally speaking, a growth outlook that we share at Pimco is that you're still going to have a growth outlook of somewhere around 1.5% over the course of the next year. That's still a positive inertia. And so despite these outcomes of tariffs and things that happen, we still see some positive outlooks to the economy, which the Fed is going to have to remain focused on, but at the same time continue to ease back to that neutral rate of 3 handle something.
Within fixed income, Jerome, where do you want to be? I look at investment grade spreads, and they're pretty narrow, around 80-ish basis points. High yield has narrowed the spread to 2.89 percentage points.
Well, a couple things to highlight here, Scarlett. Number one, you want to put yourself in a position where assets that you buy are going to have price appreciation. Treasury bills don't have price appreciation. That's first and foremost. Second of all, you want to be in the higher quality elements. So while we don't forecast a hard landing here at Pimco, and we think the soft landing is more in the realm of possibilities given by the Fed's reactions, one thing we want to do is remain up in quality. We can do that predominantly in agency mortgages as an example, asset-backed securities as a diversifier. And the third thing, just to remain obvious, but very important in this environment, is be diversified. Approach portfolio complexes specifically in fixed income with an eye on diversification and a eye to higher quality liquidity. This will give you ample runway to pivot and take advantage of liquidity opportunities when they reveal themselves. And it might be in the next few weeks as we approach the election or year end, or it might be further out. But that's a place where you can have a balance of price appreciation, hopefully producing total returns along the way.